Hello, Smart Money Sheet podcast listeners. Welcome to this week's show. My name is Kurt Chisholm, and I'll be your host. So today I'm joined with Ann Lester. How you doing, Ann?
I'm good. How are you?
Doing great. Doing great. It's a bright sunny day here this fall. Tell us a little bit about your background before we begin.
Sure. So I spent almost 30 years working at JP Morgan Asset Management, where I was a portfolio manager. I started and managed the JP Morgan Smart Retirement Target Date Fund, spent about 20 years really focusing on defined contribution, saving and investing, doing research, looking at policy areas, and really trying to figure out how to help people retire when they want to, with an amount of money that lets them maintain their lifestyle.
Nice. You really like retirement.
I
What's drawing you to that? Like what is it about retirement that really excites you?
Well, God, that's actually kind of, you're the first person to ask me that question, man. A couple of things. One, I was a terrible saver in my youth, and I really messed up everything about my own financial situation. Um, and it wasn't until I was asked by JP Morgan Asset Management to sort of look into building a retirement product and target date funds that I started learning about behavioral economics and learned how hard it is for most people to actually force themselves to save, and the power of defaults and nudges and all the things that we know now really help people save and invest. So I just think it's really cool. I also massively benefited from all of that stuff myself personally. And at the same time, I think it's an area of the financial services industry where I think, I have insights and skills that really can move the needle for people. And it's a part of the financial services world that I don't think gets a ton of love. I think people like building products for and managing money for people who already have money. And I get very motivated by helping people who aren't yet at that point kind of build their wealth. So that's why I like it.
Nice. What do you find are some of the biggest challenges people are facing when they're getting closer to retirement or thinking about retirement?
I think the most challenging thing for anybody is, do I have enough money? And then how do I spend it? And I think at its root, one of the reasons this is such a frightening question for so many people is there is actually not a right answer. Like there is no number that I can promise you everything is going to be fine. I can tell you with a 99.95% confidence rate that you're not going to run out of money, but because we don't know how long you're going to live, because we don't know what your spending needs and desires will be. Um, and we don't know what the markets are going to do. It's hard to say, yes, 100% you're fine. Now, you and I know that we can say, yeah, it's going to be fine, but you can't promise it, right? So I think that uncertainty around all of these factors is one of the big fundamental reasons why people get so anxious when they think about, can I do this? Do I have enough?
It's interesting. One of the things that's very memorable, every once in a while you see a commercial that's very memorable, and I remember the ING commercial where everyone's got a number floating above their head, and it's like, "What's your number?" Which I think was a brilliant commercial, but it's also terrible at the same time because, like you said, everyone's got a different number. So uh, how do you describe to people like what their number is? Because every day they read a blog post that says, "Oh, you should have $1 million," and now the last one was like, "You need $7 million." Like, really? Like, I don't
It's
think I
so
need 7
unhelpful.
million. Yeah,
Yeah, it's so unhelpful. And actually, I kind of push back against the concept of the number because it's not the number, it's the range. And it's a combination of how flexible are you in being able to dial up and dial down what you're spending? How locked in are you to a certain lifestyle? How locked in are you to certain minimum expenses? How much control do you have over your cash flow? And how long you can work or how long you're willing to continue to earn income. Like I retired, but I'm still still pretty busy and I'm still earning money. Um, and kind of how much you're willing to sacrifice if you need to. And so I think everybody's got different levels of those levers. And so I think the process of figuring out when you want to retire and how you want to retire is involves getting curious about those levers. I talk sometimes about understanding where your failure line is. Like I know what my success, fantasy is, fine, but where's failure for me? And failure looks like right when my husband and I first moved in together, we were living in Italy. I didn't have a job yet. He was earning nothing. And we were very, very poor, like so poor that we could afford to buy meat once a week or an English language newspaper, but not both. And we bought at the supermarket a traditional chicken, a pollo tradizionale, which just looked like a chicken, right? It was wrapped up in cellophane. Got it home, we unwrapped it, and it had been plucked. But that's it. So it still had its head, still had its feet, and it had not been cleaned, right? So we just spent like our money. That was going to be a roast chicken, it was going to be pasta sauce, it was going to be risotto. The bones were going to turn into soup. Like we were going to get every morsel of nutrition out of that chicken. And we're like, all right, well, we're gonna pull out our joy of cooking and look into the section that says how to clean game and and clean that chicken, which we did. And I never want to be that poor again. Like that's failure. That is
Yeah.
absolute utter failure. Like not being able to just say, you know what, I'm gonna go get another chicken and I'm gonna start all over again. That's failure. That's too poor. But above that, like, would I be happier with, getting to shop at Whole Foods instead of Aldi? Sure. But like, do I need to? Maybe not.
It's interesting you say that because I mean it's something about Europe. It's just different. When you're in college, you go to Europe and travel around. You can do it like a college student, no money. Once you're older, you can't, or it's harder. But there's a level of what is failure, right? There's that line of what you're willing to accept. There's probably a lot of things you can get away with, but it kind of brings up this point because our culture has been kind of bifurcated into haves and have-nots, and because of inflation and a bunch of other factors, people with assets tend to be the haves. And, when you retire, you have assets. And then there's people who don't have, or they're living off the system or the government or what have you. Um, how can people, and there's a ton of people in the middle who are just, they're kind of, a little this, a little that, but not really one side or the other yet. How can people in the middle plan for retirement in a way that they can actually have a good retirement? How should they think about it? Because they don't have their $7 million that the media is telling them they need to retire. Maybe they only have 500,000 and or 300,000 or whatever it is, and they feel like they're not going to make it. So what do those people do?
So for starters, those numbers all ought to be based on replacing income in retirement, right? So whether it's $1 million or $5 million or $500,000, like that will turn into some level of income in retirement. And you can use as a really, really, really crude rule of thumb a 4 or 5% rule. I know there's a lot of debate around whether it should be 4 or 5 or 3, but let's just say, because the math is easy, it's 5%. And there's been some recent research that says maybe that's a defensible number. If you have $100,000 saved up, that'll give you $5,000 a year in retirement income. So one way to think about it is if I've got Social Security coming in, how much of my current income is that going to replace? You can go on the Social Security website and figure it out. And then you can say, well, if I want to spend 80% of what I'm earning, which is a traditional kind of estimate for what people spend after they retire, because you're not saving anymore for retirement because you just retired. Probably you've got lower expenses, although in this work day, universe of work from home, maybe the difference isn't going to be so big. But you're not commuting, you're not buying lunch, you're not buying work clothes, a bunch of stuff that you can save money on. You come up with that gap and then you say, okay, that's the gap I need to fill with my retirement savings. And so depending on how much you earn and how much Social Security is going to give you and whether or not you have any other pension income because you were a first responder or worked for the government, right? You're going to have a hole, most people will, right? And that's what your personal savings have to fill your 401k and other savings. So that $7 million number means you're trying to replace $500,000 of income or, something like that, right? So depending on how much you were spending before, that could be a lot or could be a little. Um, I think the most important thing to do, and this works better if you're younger, when you still are very likely to be seeing meaningful raises every year, in the first sort of 10, 15, 20 years of your career, you typically get raises that are meaningful and higher than the rate of inflation. As you hit your 40s and 50s, that party tends to slow down a little bit or maybe even stop. But if you're younger, right, the best way to boost your savings rate is to save more tomorrow. And that is to promise yourself that the next raise you'll get, you'll save half or more if you think you're behind. And that way you're not having to sacrifice anything today. You're not cutting into your spending today, but you're saying, great, when I get that raise, I'm not going to buy a new car. I'm not going to use that money for a vacation. I'm not going to do this thing that I'm dreaming of. What I'm going to do is say, great, I'm going to take almost all of that money and put it away for my future because that's how I can fill that gap. If you're older and don't think you're going to be getting raises, then it's a little harder because you really have to think about levers you can start pulling to shift some of your spending now so that you can put it away so you'll have it later. And that's tough.
Yeah, I mean, I'm not gonna ballpark your age, but I'm a Gen Xer, and I think we're the gap, the gap generation where we basically kind of get hosed on all sides. The boomers, they hollowed out the economy. They got all the benefits of rising stock prices. Now they're pulling money at the top, and of course, who knows where that's going to go. But it feels like subsequent generations from the boomers have gotten the short end of the stick, the millennials included. Um, and I wonder because I know there's a lot of bad feelings about that, and kind of the boomers drove the economic or certainly stock prices up, and now as they pull money out, they'll probably drive it down a little bit. But I wonder about subsequent generations. You mentioned the millennials, or Gen Z, or all these generations. I feel like a lot of them are in a place where they feel like they're outside the system almost. Like in Gen X, like we're still in the system. It's a lot harder for us. Like things just didn't go smoothly. Like, I started in 99 working, and it's like the market just went straight down for like 3 years, and then we had the housing bust, and all these things that just kind of happen at certain life cycles of Gen X. Whereas the millennial or the boomers had it easy, and then the millennials, I feel like they got hollowed out because they started when it was hard to get jobs. So it's gotten subsequently harder generationally. So I'm wondering, like, how, like, some of them just gotten disenfranchised from the system altogether. So how should people like that look at it? Because the whole fire movement started, and a
Yeah.
lot of other things started because of this. How should people in that generation be thinking about this? Should they just be thinking differently? Like they should retire early? Should they be thinking in a more, I guess, thrifty way, meaning they don't really need much? Or how should they be thinking about it if they don't have the wealth needed to survive at a later or even a retirement stage?
So just for the record, I'm a boomer. Last year, the boomers. Technically speaking, although I guess some people say there's a little bridge group, and I'd be in that bridge group, but technically I'm a boomer. So it's all my fault. You know, it's interesting. Here's a fact. Gen Zers and millennials have more money saved for retirement than either Xers or boomers did at their age.
Hmm,
Statistics, right?
interesting.
One of my favorite textbooks in college was a little book that was written in the 50s or 60s called How to Lie with Statistics. And it basically has informed me about how to be very skeptical when I look at numbers. So I just gave you the statistic, right? Gen Zers and millennials have more money saved for retirement than Gen Xers or boomers did because of auto enrollment in 401ks. Boomers were the first generation who had access to 401ks, but they just came into existence 50 years ago, right? We just celebrated the 50th anniversary of the law that kind of created the 401k system in 1974, but people didn't really start using them aggressively until the 80s. So boomers were already in their 30s and 40s before they started saving. Now, they had a tremendous bull market to help them, but they actually missed out on 10 or 15 years of compound returns in the 401k plan. Now, a lot of them have rump pensions, and they've got a whole different set of things. They were able to buy really cheap houses, so they had a lot of advantages. You said earlier, you spoke of the have or have nots, right? One definition to me of a have or a have not is a worker who has access to workplace savings, right? A worker who works for a company who offers a 401k plan. Only, depending on statistics and who you talk to, somewhere between sort of 2/3 and 3/4 or maybe half of all Americans work for a company that offers a 401k plan. So That's a lot of people who don't have access to the single most powerful wealth building tool we have, which is your employer will help you by automatically deducting money from your paycheck, matching it in most cases with free money, and then letting that sucker grow for 20 or 30 or 40 years, right? That is a great way to build wealth. So for Gen Zers and millennials who work for employers who enroll them in 401k plans, they're like off to the races. And if they stay the course, they're going to be just fine with saving for retirement. They will probably struggle to buy a house until we see more housing supply come on the market. Now, again, where I live, I'm seeing like housing being built everywhere suddenly. So I am hopeful that that supply demand problem is going to start coming back into balance. I think, boomers are sitting on a lot of real estate. Like you talked about them selling stocks, they're going to be selling houses too. So at some point, there's going to be more supply because the boomers will not be moving into different houses, which they're doing now. They're selling and then buying cash, right? And downsizing. At some point, the things they've downsized into will just be sold as they no longer need those houses. So there's going to be more supply coming on, and I am hopeful that that will help bring our sort of big housing crisis back into balance, right? We're short millions of units of houses in this country. Um, I will also throw out there that I see this talking to my own kids who are in their mid to late 20s and their friends that I think there are a lot of kids who come from sort of middle class and upper middle class backgrounds who have an expectation that their lifestyle will be the same as the lifestyle they grew up in. And I was pretty blunt. We were very blunt with our kids. Is like, guys, like you need to do this, right? You're not going to have the lifestyle that you have at home with us when you start working. We expect you to kind of figure it out and make it work. And yes, we're here to backstop you if you need backstopping, but like figure it out. And so I do think some of it is figuring out the lifestyle you can sustain on the income you have, um, and moving forward from there and expecting that then to increase as your salary increases and as your overall wealth increases. That was a long answer, but yeah.
No, it's good. It's good. I appreciate that because you're talking about housing. And, one of the things that I find interesting is, the boomers are, s- I mean, they have kids and the housing has become so expensive in many areas that the only way that their kids can afford a house is by t getting money from their parents. I mean, which the challenge is we've always had this starter home up to wherever you end up in your home, but there was always starter homes, and now it's gotten too expensive for people to buy starter homes. And so the only way that the youth or the millennials or whoever can buy houses is by getting money from their parents. And that's tough because obviously a lot of parents don't have that to give. Um, so then how do you get on the right foot as a millennial or Gen Z? Like, how are you getting on the right foot if you can't afford to buy a home? I
So
mean,
again, I think that's one of the great challenges for this generation if they weren't lucky enough to get into the housing market, before 2020 when things really got crazy. Um, the median price of a median home has gone up 6 times in the last 40 or 50 years, and the median salary has doubled, right? And that's the thing we're talking about. I will also point out that median houses are larger per square foot and have fewer people living in them per square foot than was true 50 years ago. So some of the reason those prices are so high is because they're bigger and nicer per person, right? I'm just saying, right? So I'm not saying that's a bad thing. I'm saying we should all be aspiring to live in nicer homes, but it's not just inflation. There's actually a better thing there, especially if you're looking at new housing. So I would just throw out that comment that we are getting more for our money, which it's easy to lose sight of as we're feeling grumpy about this whole situation. But that doesn't make a 20 something feel any better about the whole problem. Um, like I said, I think it's going to take 5 to 10 years for that to swing back into balance, and we're going to have to see more supply, and we're going to have, I think, as the demographic, the pig that is the boomers moves through the python, we're going to see more housing emerging and more supply available, just because you're going to see people not wanting those houses anymore, or needing those houses anymore. So I do think that it will get better, but it's not going to get better, in the next 5 years, unfortunately.
yeah, I wonder how much that has to do with the frozen housing market because rates went up so high and people I mean, around here, people were going to move and then rates jumped up and they think, well, if my monthly payments have doubled, why not just stay where I am? You know, I want to
A hundred,
downsize, right?
100%. So again, I think it's going to take a while for that to work through the system as people's ideas of what normal is starts regularizing, as people pay off some of those mortgages and are able to sell. I just think that stuff just takes a while. We're in a tough spot right now. I remember when we were looking for a house, our first home that we bought in 1997. I don't know that mortgage rates were much different than they are now, right? So what's your idea of normal? Now the house is appreciated a great deal, right? So that payment is higher. But I just think, again, it's going to come down to supply and people building starter homes now. New homes are getting smaller. Stuff is shifting in the market. There's more multifamily housing being built, which is going to be more affordable for people to buy if it's a condo situation. So I do think the market will eventually respond. It's just not going to be fast, and that's tough and painful for people who are looking to establish that foot in the real estate market.
Yeah. Yeah, no, it's an interesting dynamic going on in the real estate market now. I mean, certainly there are other places people can live, right? They don't need to live in the highest cost
Right.
places, but um yeah, it definitely makes that interesting. So one other area that I find interesting is you know, the impact of AI and how that's going to impact both the economy and um you know, I guess you could say the financial part too, because I think it's probably going to incorporate itself into more of our daily lives. Um, and I wonder how much people are going to be relying on it for things like, you know, their financial well-being and, you know, are they going to learn good money skills or are they just going to rely on AI to tell them what to do? Um, how should people be thinking about that when it comes to retirement or, I guess, financial wellness?
I think it's too early yet to know exactly what we'll see. I know when I was still in my job at JP Morgan, we were already very excited about the things that you could hypothetically do with data sets and machine learning, forget, generative AI, on helping people understand more about their habits. To me, the most exciting thing about the evolution of technology and the evolution of behavioral economics is this ability to get better at understanding what prompts you to go off the rails, right? I always say I would have failed the marshmallow test as a kid. I would fail it today. So right, I've learned over over the last few decades what prompts me to go outside of what I theoretically want to do, and what tempts me to spend. There's certain stores I refuse to enter unless I know I need a specific thing because I'll try something on and buy it even if I don't need it, right? I'm just like, I'm not going in there. Just won't do it. Um, that's why for me, and I think for many people, the automatic savings, the automatic investing, right? I used to run target date funds. I used to be, tactically allocating money. Um, I won awards for it. And I would, in my personal portfolio, just fall into every single behavioral trap about like, I don't know if I should invest that cash. What if the market goes down? It's like, oh my gosh, like I do literally do this for a living. And then when it comes to my own money, I struggle to follow my own advice, right? So to me, AI can help highlight and well, I think there's a possibility that you can learn a great deal from someone reviewing your own transactional history, right? If you can have somebody look at how you spend money, talk talk to you, interact with you about what you want, and then show you ways that you are could take advantage of making different choices. And then ideally in the moment, maybe it could prompt a different decision. So, it's often, that sort of thinking fast, thinking slow brain, right? What can we do to interrupt that impulse to do something? Because if you can interrupt it, it gives you a chance to say, well, wait, is that really what I want to do? But it's hard to interrupt that impulse. And so I think for me personally, having an AI helper, I used to joke about having your phone buzz when it sees you walking into Starbucks for the third time that day. Like, you don't need to spend that money. You can still do it if you want to, but is that buzzer enough about, oh yeah, wait, I said I didn't want to do that. Right? I can see AI helping a great deal there. I don't know that we know yet what it is capable of. Obviously, we're all on this journey of exploration together. But to me, it's how do we get out of our own way, and how can we learn more about our own money habits and get curious about them so that we can start creating a framework that lets us succeed. That to me is the most exciting.
Yeah, and it also brings out this, what is the definition of success? I mean, I think about you mentioned the carpenter with the leaky roof problem, right? You have the same problems that we all do, which is good to hear, right? And that, we're all fallible and it's not there's no perfect system. But when you're talking to people who are in, Gen Z, millennials, I think Xers are probably pretty self-reliant because our generations is how we were raised. But how do you balance the now versus later? And I have these conversations with retirees all the time, and they're like, "Oh, I gotta save. I can't spend the money." And they got like $2 million, and they're like, "I can't spend the money. I'm gonna run out." I'm like, "You're not gonna run out. Like, at 90 years old, you're gonna be wondering, oh, I wish I had done this." So, how do you balance that now versus later conversation with people?
I think it's incredibly difficult, and I have that conversation, had it with my parents for years, which is you're gonna die with more money than you started with in retirement. Like what are the things you wish you'd done? And sadly for them, they're both 90 now, and those choices are no longer there, but they've got a nice healthy cushion for healthcare should they need it. But um, it's very hard to go from training yourself to save, 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 save to saying, okay, now it's I have permission, right? How do I give myself permission to spend? Um, One of the things I think is the most difficult when you're in your 20s and 30s is to understand the consequences of choices you don't realize you're making when you spend money today instead of saving it for the future, because it's very hard to know when you spend that money what it could have done for you or might do for you in the future. So I talk about an $800 piano that I bought with my very first bonus check instead of taking that money and paying down my credit card debt. And that $800 piano cost me $29,000, which is what that money would have been worth if I'd invested it in the S&P index fund in my retirement plan at work. 800 bucks.
Wow.
And 36 years later, that would have been $29,000. So that thing that you're doing, is it really worth? Now, I can't guarantee the S&P will do what it's done over the last 36 years, speaking of boomer privilege, but from 1987 to today, but uh, that's a lot of money. If I'd understood that piano was costing me that much, would I have bought it? I don't know. Maybe, maybe not. But I would have understood what I was doing, and I had no clue what I was doing. So to me, the power of compound returns to me is one of the most important things. And in a way, when you have that client of yours who's got this portfolio and is not spending it, that it's also the power of compound returns, right? You can't, you have to spend pretty aggressively to spend down $2 million if you're 90, 80 years old. Like, just do the math. If you're 80 and need to plan to live 105, that's 25 years. Divide 2 million bucks by 25. Are you really going to spend that much money? I don't think so. So you're okay. Enjoy it.
Yeah, boomers are notorious for being great savers and not being great spenders.
Well, they also had parents who went through the Depression,
Right.
right? And
Yep.
parents who did not grow up on credit. And so, and this real mantra of do not touch your savings. It'll be curious to see as new generations move into this phase of life, right? As the young boomers and the Gen Xers start hitting this point, whether or not they'll be able to spend or not. One of the things I do is I'm a education fellow for the Alliance for Lifetime Income, which is trying to help people understand how to use guaranteed lifetime income, annuities, and other products to help convert a portion of their savings into income. And there's a lot of research that shows that gives people permission to spend it because it's been
Yeah.
converted into income for you. And we're not trained to think of our savings as future income, right? But we're saving for retirement, we're saving for the future so we can spend it, not to be a dragon and sit on our hoard of precious coins, right? It's actually to be used for something. And so I think the more we can keep framing my savings are because I want to do X, right? And that money should be spent for Y. But then you get into where we started, which is that existential uncertainty of how long will I live and what will my healthcare needs be? And then you get very scared about spending.
Yeah, I've always found it's a difficult balance, and generationally, it's very different. I mean, the boomers are notorious for saving. They don't spend it. They end up dying with all the toys. They don't use them. Um, and I agree. I think growing up with parents in the Great Depression, I mean, my dad grew up in the Great Depression, so I heard all the stories. I've got all the skills on how to not spend money and all the cognitive bias of, you got to save for rainy day and all that stuff. So I get that. But I think the younger generation has done a better job of being more balanced. I'm not sure if they're going to be ready. And I think the concern I have is I think they're more balanced and more, I guess in some ways they're better with money, but on the downside, I think they have a harder setup because I think the economy is set up in such a way so they're going to be less likely to succeed unless they inherit money from their family.
Well,
Um,
I'd throw in another dimension too, which is the availability of credit and the comfort with using credit, which again, my parents certainly didn't have. I got my first credit card when I was in college, and boy, was that a horror show and explains much of my subsequent problems in my 20s and early 30s. Um, and I think there's just a ton of credit around now. And I think consumers today are far more savvy about the consequences of credit, and credit card companies have to disclose how long it'll take you to pay off your credit card at the minimum rate, which was certainly not true when I was getting my first credit card in the 80s. But it's 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 going to be very interesting to see how this all works out. But if you look on paper, again, this is how you can lie with statistics, right? I just saw a chart the other day showing that millennials have more in assets on average than either boomers or Gen Xers did at their age because of the run up in housing prices and because of the run up in the stock market. So if you are a have and have bought into the housing market and have an employer with a 401k plan, you're doing better right now on paper than Gen Xers or boomers were at the same age, which is not conventional wisdom. But as you point out, this average statistic, right, completely masks the very much have and have not nature of Gen millennials, which I'm gonna guess is a little more extreme than it was for boomers at the same age.
yeah, I think that the challenge is getting into the system versus not getting into the system,
Yeah.
right? If you have money
Yep.
in the stock market, if you have a house, you're in the system, right? And so the appreciation of the stock market and of the housing market will benefit the haves, and the people who don't get a house or don't have enough to invest in the stock market end up being the have-nots because they never get in, so they don't get the benefit of the growth,
Right.
which of course masks the inflation problem we have, and that affects all the people who are the have-nots, and I
Absolutely.
and that certainly has diverged quite a bit in the last 50 years. I'm not sure if that will continue or how that will look another 50 years or 30 years from now, but it's certainly not in a good direction at the moment. So um, so how should people be thinking about that? Like what, because, should it be just focused on I need to have a home, I need to have assets, or like, because I know some people are just they're just enjoying life too, and there's a good part of that generation. People are just enjoying life and they're living for the day. So what's kind of the wiser way to look at that for people to kind of bridge
Right.
that?
Well, I say first and foremost, you've got to have an emergency savings fund. Like you just absolutely 100% have to have at least 3 to 6 months in cash set away in a high yield savings account where you can get it tomorrow if you need it, because life happens to you, whether it's an accident with your car, whether it's uh, you or your spouse losing a job. All kinds of stuff can go wrong, and it will go wrong at some point in your life. And having that savings is just critical to avoiding falling into a hole that's impossible to crawl out of. Um, Second thing is if you have access to workplace savings, you've got to be in that plan and you've got to be getting the free money from your employer. And if you do those two things, you're already on your way. And again, for younger people in particular who can expect those relatively frequent, relatively sizable raises for the first, call it 10, 15 years of their career, the way you step into saving is not by cutting spending today, it's by not spending your raise tomorrow. And that psychologically is a really powerful way to really boost that savings rate. And if you do that over the course of 3 or 4 or 5 years, and you get, let's just say hypothetically, you get a 5% raise every 6 months, you will find yourself saving 10% of your income in 3 or 4 years without even necessarily feeling it. And that to me is the most powerful way to get in the game, get in the system. If you don't work for an employer who offers a 401k plan, if you're gigging, if you're a solopreneur, it's harder because you have to set up your own retirement savings. You've got to set up your own IRA or Roth IRA. You've got to pick investments, right? You've got to do more legwork, but it's still something you can automate and have happen every time you get money hitting your account. And that is, to me, again, a really powerful way of getting your feet into the system. Once you start doing that, then you can start saying, well, great, I'm going to start building up a fund to get a down payment for when the housing market gets less crazy, because it will get less crazy at some point. It really will. This is unsustainable forever. It will come back into balance. I just sadly think it's going to take more than a year or two. But that gives you time to save up that down payment.
Yeah, well, I think in some ways, a lot of us hope for that housing downturn,
Well,
but
it's
at
a
the same time, we
double-edged
don't.
sword.
Yeah,
It's a double-edged sword there. There are going to be a lot of people who see their retirement dreams go poof if that housing market like
yeah.
corrects. What I'm hoping will happen is it just stops going up, right? As you see more supply coming on the market. And then, if housing prices don't go up for 3 or 4 years, then inflation is going to catch up with it and people's incomes will catch up with it. And then you'll suddenly be in a much better position to have people buying again. But a crash would help people who don't have a house yet, but it's not going to make most people very happy.
Yeah, I mean, I think it's the same way with the stock market, with the housing market, any of these markets is that they're really expensive, and at some point that will correct. Who knows? Maybe the sideways correction is the most
Yeah.
optimal, but
Yep.
but at the end of the day, we've had two once in a lifetime buying opportunities in the last 20 years, 25 years. And I'm sure there'll be more because that just seems to be the way our economy works.
Yep. Yep.
Um, but yeah, I think just so as we kind of get close to wrapping it up here, what are some final thoughts you can leave us with some, good tips or tricks or ways to think about retirement that we haven't covered already that you think are really important for people to know?
One thing we haven't really talked a whole lot about is actually investing the money. And as I sort of alluded to myself, even though I did it for a living and I think I was pretty good at it, it's not always easy to do it for yourself. And so I think having a professional helping you, whether it's a financial advisor, or if you're younger and maybe don't have the assets to work with an advisor yet, something like a balanced account or a target date fund, I think those are great ways to keep you in the market when the bumps and the corrections happen. One of the most biggest tragedies that I saw was both people getting close to retirement and younger people seeing what happened in 2008 and saying, well, I'm not going to do that. I'm going to keep my money safe in cash. And that they missed the biggest bull market in history. And you'll never get that money back. It's selling high when things are looking good and buying low when things are looking scary is actually very hard to do. And that's the way you make money. Most people want to put money in the market when it's going really well because it feels good, and they get scared and want to sell when it's going down. And that's, again, the opposite of what you should do. So I think making sure that you're working with a professional or using an investment strategy that does it for you is one of the most powerful things you can do to keep once you've got that money saved up and invested, to keep it on track and keep it growing.
Okay. And then one other final question you kind of led on to. How should people be thinking about bonds? Because in the last 50 years, we've had a pretty much a static opinion of bonds, that bonds are safe and they're going to produce lower volatility, which is true up until 2022. And who knows where things are going in the future, but certainly they're not going below zero. So how should people be thinking about bonds in their portfolio? Are they safe, or should they be looking at other alternatives, or what are your thoughts?
Yeah, I wasn't still managing money when that all happened, but I do remember thinking, at some point bonds are going to have a nasty year and they're going to go down. I confess I did not predict they'd go down as much as they did, but they're going to go down and it's going to be the worst betrayal in anybody's life. Like the worst year in the bond market was nowhere near as bad as the worst market in equities, right? Like a quarter, a third. of the correction. Like what was the worst year in equities? Down 45, right? Or rolling 12-month period bonds were down 12. Like you can't compare those two numbers, but it was the insult and the outrage, right, of this safe thing going down. Statistically, right, that correction we saw in the bond market was totally predictable. What was not totally predictable was the fact that the bonds went down simultaneously with the equities, right? Usually, economic theory would tell us that they tend to move in opposite directions. And so I think what was so devastating about what happened in 22 wasn't just that this safe part of our portfolio fell, but that they were falling when, economic theory should have told us that equities would have been rallying. So overall, your portfolio would have been safer. So again, I would say, rationally, that was also a predictable outcome if you run simulations and look at what could happen and, play with macroeconomic theory. Like it's in hindsight not surprising that happened. And this is the reason why I said what I said earlier about working with a professional or working in with a strategy that manages these things for you. You only lose money in markets like that if you sell.
Yeah.
And if you don't sell, your portfolio will recover. Now, bonds haven't really recovered that loss, right? Because they don't appreciate in the same way. Although you've had 2 years now of 5% interest rates, so you're almost back, right? If you've been clipping those coupons and sticking them in your bank, right? You're almost back just from the income on those bonds. The equity market's up enormously. So your portfolio as a whole, that was a little tiny bump in the road for your portfolio. From a like, are bonds good to buy? I do not believe that the reason you hold bonds has been fundamentally challenged. You fundamentally hold bonds because they typically move in the opposite direction as equities, not always. And let's not forget that for a really long time, they moved in the same direction as equities when interest rates were dropping. Your bonds were going up and your equities were going up, right? So again, if you're a boomer or an Xer, you benefited from that, you know, non-normal correlation for a long time. So we shouldn't be surprised if every once in a while it whips back at us. And I guess I wasn't surprised, and it not nice, and it was painful and agonizing, and you think terrible thoughts about what you bought and how could this be doing it to me. But this too shall pass, and I don't see anything that would tell me not to continue owning fixed income. And frankly, at this point in the cycle, and the market's already moved, frankly, I mean, I was talking to my advisor about going long fixed income 9 months ago because I was like, you know what, this is going to be pretty good for a little while here, so let's buy more. But I don't advise most people to tactically allocate. I think that's probably not a good use of energy. But I think the fundamental case for owning fixed income is unchanged. You just can't be naive about sometimes things go down.
Yeah, I
The
think
trick
that's
is
the
not to
hardest.
panic.
Yeah, that's the hardest thing is
Yeah.
everyone feels good, it's great, and then when things go down, people it's just this bipolar experience of everything's great or everything's terrible, and there's just not a lot of things in
And
the middle.
I think people feel betrayed too. Like, how could you do this to me? I was counting on you, right? And there's this really emotional reaction. But again, if you've got a cash cushion and don't have to sell, don't sell, and it'll kind of work out.
Yeah, yeah, I agree. Well, Anne, we got to wrap it up here. Where can people find more about you?
Well, you can find more about me on my website, which is my name, annlester.com, and with an E. You can find out about the book that I wrote and published, came out about 6 months ago, called Your Best Financial Life. And it's really aimed at Gen Zers and millennials to help them navigate all the questions that we've just been talking about on this podcast. But I think it's got some tips that older investors and savers will learn from as well. But those are the best ways to find me.
Nice. Well, Anne, I really appreciate you coming on the show, sharing your wisdom with us. I'll put all that in the show notes for listeners who want to go grab your book. Thanks again. We'll probably have you back in the future because people are going to keep retiring every single year.
It's a gift that keeps on giving. Thanks so much.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. I mean, like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Ann. I really appreciate her coming on the show and sharing her wisdom with us. Now we're into the panel portion of the show where we have a new panelist, Jeff Hewlett. Hey, Jeff.
Hello, hello. How are you, Kirk? Glad to be here.
Doing well, doing well. Well, glad to have you. We got an abbreviated panel this week because it's a week after the election. I think everyone's burnt out and everyone's on vacation. So we it doesn't happen often, but it's a small panel, so it's just gonna be me and Jeff this week. But so Jeff, so what are some of your thoughts from the interview? What were some of your takeaways that you can share with the audience?
Well, first of all, I think I really love the work that Ann Lester does. She's been around for a while, and she's retired, so she's really bringing her knowledge, her abilities, and really applying it to kind of the current world and how people can really deal with and change to our changing world. So I think that's great. So glad that you had her on. So one of the places that I go to is the generational change. Whether we're talking about millennial, Gen X, or even younger than that, and really, in my mind, the very different headwinds and challenges that they face than say I face. I'm older than you, Kirk. I know. I think I'm maybe a half generation older than you, but really, even for both of us, they're different challenges. I kind of put that, I call it the information abundance challenge, right? With our iPhone spewing data on us all the time. But those sort of things are different and really create massive challenges to thinking about retirement. So one of the things that, one of the challenges I hear and what I connected with Anne was, back in the day, back when I was younger, when I was starting out, there were DB plans, right? Defined benefit plans. And there, during my life, it really transitioned from DB to DC, which means it was almost like it was a secret, quiet thing where it's like for employees, they said, "Hey, we've got this new thing called the defined contribution plan. It means that you can move from employer to employer, it becomes portable." They sold all the good sides of it. But the problem was they didn't tell the employees that, well, you still have to sign up for these contributions. And what ended up happening, of course, is people didn't, right? And so, we've kind of created this generation of people that are really underfunded for retirement. And what I heard Ann talking about was that's changing, right? Whether it be from work of people like Richard Thaler and others that kind of got into the whole, defaults around decision making and changing the approach that people use for their retirements and how companies are now auto enrolling people. That's a very positive thing. But that's really for now. We actually kind of lost almost a generation or so of people till we figured out, oh my gosh, Houston, we have a problem. So I like a lot what she talked about there. I do think it's better. But I still think that there are some holes. I do think Ann was right in that people are underfunded for retirement. I do think that there are some folks, and maybe some of it has to do, Kirk, with social equity. Like I think of my children, they are probably almost neurotic in how they save because, it's like they were born, they said WA, and I said auto enrollment.
Yeah.
So it's been this mantra of talking to my children about what it means. And so now they have fully funded 401ks. They will absolutely be 401k millionaires long before I reach that status, because of just that cultural programming that my wife and I provided for our children. But not
Yeah,
everybody has that, right? And so
that's
I think
great.
the challenge is how do we increase those habits, right? And sure, training parents or getting folks to think about that, but how do we do it in a broader way to help a larger group of people?
Yeah, it's interesting. I mean, you made a lot of great points there. So what I find fascinating, I was thinking back as you were talking about the pensions, and I was thinking about as you're talking about, the old school, like when I started in '99, pensions were still a thing. If you remember back like decades before that, like you said, everyone had pensions and 401ks weren't really a thing. Um, and then and then you had these mergers where they would gut the pension, right? They would, what was it? Barbarians at the Gate was, and KKR and all these firms would go in and they would just gut the pension. It was just like free money basically. And so, you look at things like that and say, wow, like, isn't it great we have defined contributions? But now it's beholden upon us to actually make that contribution, which I was surprised to hear Ann say that like 50% of people were um 50% of the people were enrolling in their 401k, which is shocking to me. Like I thought it'd be a lot higher. Like the younger
Hmm.
generations, I feel like everyone just knows this. It's just part of like when I got my first job, it's like set up a 401k, contribute to it. Okay, great. You never see the money again until you retire, but like I know it's going in every month. But it just feels to me like how do people not know this by now? It seems like it's common sense. So, but it's interesting seeing the generational aspects of this, because every generation has a different experience. Like the boomers have a very interesting experience. Gen X is very different. Like we're on the tail end of all the good stuff. In many ways, we're getting all the bad stuff, and then you got the millennials who started in the like 2008 when the bubble burst, the housing bubble crashed, and everyone's like, I don't trust the markets, I don't trust this because that was their first experience. So I'm always fascinated with how these things work, but I did want to get into another part of it with you, which is really talking about like cash flow. And you obviously have a lot of experience with this, but looking at cash flow, I think people don't spend enough time understanding cash flow, whether it's current or retirement. So, how should people be thinking about income or cash flow in retirement, from your perspective?
Right. Well, so as an economist, I think of, consumption and savings, right? And if you, from an economic way of brain thinking about it, is all savings is future consumption, right? So it's consume now, consume later sort of thing. So, when you're thinking about retirement, to me, all you're really trying to think about is what cash do I want to have available to me when I retire? And frankly, Kirk, what I think most people don't necessarily have a clear relationship with what retirement means to them. And in my view, that's where you need to start. So in other words, like if almost the entire world, except for America, thinks of retirement as just a changing of stuff that I do, that perhaps is more related to stuff I want to do versus stuff I have to do, right? So retirement is not stopping, it's just different, right? And whereas Americans, in my view at least, and from what I've seen, have a very different view. I mean, to me, it's you work really hard and then you stop. And, but not everybody's that way. So part of it is first starting with, well, what does retirement mean to you, right? Do you have more the traditional American version, if you want to call it that, versus sort of the way everybody else thinks about it, version of that? Like for me personally, I'm probably going to work till I die, is the way I look at it. It's just over time, more of the work I do is going to be more of the work that I want to do, right? Versus the work I have to do to raise my family or whatever. So anyway, but so with that in mind, right, that means, well, how much cash flow do you need? And how do you think about that? And that to me is I have pretty much when I've talked to people about and I talk to my students about it, like at JMU, it's more about, setting up savings habits when you're young, what I call like a pay yourself first approach, which is a very traditional approach, but a discipline that sets money aside in their 20s or even earlier if you can, but certainly in your 20s after you get out of your primary schooling and make it available for yourself at retirement. So to me, if you start and what I'll tell my students is, and we model this out, if you start in your 20s, putting in a reasonable savings rate with a typical undergraduate sort of income that basically grows at a reasonable rate through their life, they'll end up with $16 million for retirement. And $16 million for retirement would put them in the top 1% of American wealth. What's crazy to me is that's average. That is like literally like this, I'm not talking Wall Street, I'm a trader kind of income. I'm talking about I got a normal job after college sort of thing. So the point is, if everybody can get to the top 1% of wealth, but nobody's doing it because we only have 1% of Americans that are in that group, what are we doing wrong? And to me, it's all about wasting our 20s in a way, because as you know, with the time value of money, most of the bang comes, if you've got a 40-year runway, most of the bang comes in the first 10 years. And that's where we're missing it.
Yeah, I think I think one of the things also is hard is we talk about things in hypotheticals. I mean, you're a professor, right? And a lot of the things you teach are concepts and they're hypotheticals. But like when you get into like real life, that's not how it works, right? It's not like, oh, I put in 7,000 a year and it grows at 10% a year. Like that's not how it works, right? Some years you might put in 10, some years might be nothing because you lost your job. Sometimes it might be 20. And then the returns, sometimes it's negative, sometimes it's 20, sometimes it's 5. Like, and so like I think one of the challenges a lot of people have is if you think about like millennials when they started during like the Great Recession when the Wall Street housing market kind of imploded, and that was their first experience. A lot of them were turned off by the whole thing. They're like, I'm staying out of Wall Street, like,
Right.
or they start saving and then the market goes down. Like, well, that's stupid. I'm not doing that again. I just lost half my money. And they
Right.
don't understand the concept yet because it's still new, right? And yeah,
Right.
I learned about this stuff in economics class, but it doesn't mean anything to me. Like economics, I get a background in economics too, and it's all, it's
Right.
all theories. Like it is
Right.
theories after the fact, right? Or it's like
Yeah.
MPT, which is MPT is funny. It started out as an academic theory. Wall Street saw it and said, "Hey, this is a good idea. I can use this to sell more mutual funds." So they took it, packaged it up, made it really sexy, and they're like, "Hey, diversification is great, and you're all set if you diversify. So now put all your money in and you're safe." That's not the whole point. Like, it totally
Right.
messed up the intention of the thesis, which was it's not about diversification. It's about diversifying with low to no correlation or even inversely correlated assets. But people don't say that. Oh, just put it in 8 different mutual funds and you're fine. Like, no, they're all correlated. Doesn't matter. They must as well be the same one. So I think, one of the challenges I think for a lot of people is the first impression.
Right.
And then life, right? Life gets in the way.
Right.
And when life gets in the way, it's kind of like, I got to save for a house. Should I really be saving for retirement? I really need to own a house. And then it gets into this kind of back and forth of, well, actually, I need to buy a house. Let me take out that 20, I don't know what it is now, 20,000 or something you get as a, without
Right.
you have to pay income taxes, but you don't get a penalty on it. So you get
Right.
this amount you can take out, and then there's money you're taking out, and oh, I got my
Right.
kids' college, and it's just life, right?
Yeah.
It's hard to be so regimented that you're following a blueprint step by step and you don't deviate. Most people deviate, and I think that's
Right.
one of the big challenges for people. I mean, what are you seeing?
Yeah. No, no, I mean, we so there's a lot there you just hit on. Let me sort of um kind of get into it a little bit. So completely agree, life happens. Completely agree, we have heuristics and cognitive biases that kind of impact, we're very front focused. We have, I won't go into all those things, but we have all that stuff. There's no doubt about it. But I'm not, I'm not going to give people a free pass on this one. And then let me tell you what I mean by that. In other words, the theory versus the execution. Yeah, it takes some discipline to do this, right? There's no doubt about it. So it starts with making the right choices. If you're going to go to college, making the right choices about going to college and really being focused on ROI, not overspending on college, which is short for not having a big debt service payment when you come out of college, right? That basically puts you in a hole. So, if you have parents that figured out a way to get you through college with little debt, where you were that person that was able to get through college with little debt, God bless you. That was probably one of the smartest decisions you made. But the sad thing is, at 17 years old, most high schoolers aren't making super informed decisions unless they have a little bit of guidance. But when we talk about the disciplines of life happens, but life happens if you live in a relatively low cost situation where you're able to if you're renting, keeping your costs down, finding a way to keep your costs down and setting money aside. I agree there are trade-offs, but to me, the most important thing that somebody can do is keep their fixed costs down. And to me, that's some of the challenge, right? So life does happen, but if you've built up your reserves for when life happens, it doesn't impact you as much. And then you can truly save for both the house as well as managing keeping your retirement going and doing both a house as well as having your retirement going. But it may mean that maybe you're not living, in the day-to-day life, perhaps you're living a little more frugal lifestyle. I don't know. It really depends on their job. So yeah, I don't know. I hear what you're saying about theory, but from my standpoint, when I teach in my class, I tell them this isn't theory. This is fully tested on my life, my family's life, other people's lives that I've worked with. So while it is a theory, it's a theory backed by a ton of testing and experience. So I know it's possible, Kirk. I absolutely know it's possible. The challenge is not everybody's doing it, right? And not everybody gets the advice to be able to be helped along the road to do it.
That's true. I think that's an important point too, is that and it's not even academic, right? It's
Right,
situational, it's environmental, right? If you grow up and your parents know nothing about money, then you're probably going to be struggling with money because you didn't get the right
right,
foundational elements. Um, my dad was a thrifty Scot, and so he taught me how to be thrifty and how to save a buck. He
right,
didn't tell me how to invest. He didn't tell me, how to think about growing it. It was just save for a rainy day. He grew up in the Great Depression. That's all he knew, right? When he
right,
grew up, like he was moving houses like periodically. Like they were in different houses every year because they couldn't put food on the table. Like the Great
right,
Depression was a very tough time for a lot of people. Like I remember as a kid, he would drive around the neighborhood and say, "Oh, I lived at that house, I lived at that house." And after like 20 houses, I was like, "How many houses you live in?" He's like, "Oh, we moved all the time, like sometimes once a month because we didn't have rent. So we just moved." And I was like, "Holy crap, like that must have been an awful period of time
right.
where I mean, you imagine, I
But
mean, you hear about it, but like,
right.
God,
But I wonder though, when I think back to the most challenging times in my life, like, and I think back to my family and my wife. I also think back to is also some of the best times of my life. Like it was hard, but we did it and we did it together. Like, I don't know if your dad had, it'd be interesting if you could talk to your dad about that. Like, but to say like, yeah, it was hard, but did you think it was that hard at the time? And, is it what it was a different time? I
Well,
don't
it's
know.
just what so
I
I
wonder
mean
sometimes.
he's passed now. I mean he grew up in the
Right.
Great Depression. He was a kid. I heard all the stories. Like he would tell me the story. His mother, like at dinner, would be like, "Oh, I'm not hungry. Why don't you have my hamburger?" Like
Wow.
obviously she was hungry, but she
Right.
was, like this is a different time. Like no one since in this country has experienced the same kind of stuff because we
Right.
have social safety nets now. They didn't have any then. He used to
Right.
tell me he'd go to the neighbor's yard and steal an apple out of their yard because so he had enough to eat. Like
Right.
it was a
Wow.
crazy time. Now, granted, it wasn't all crazy, but it was definitely bad in many ways, and people didn't have jobs. And I mean, I heard all the stories. When you
Right.
grow up with a mindset that everything is bad and you have to save for any day, that's really hard to break,
Right. And
right?
it's a
Like
good habit to have.
it is. It's a good habit to have, but it also hinders you. So
Right.
what I learned because I grew up with this, right? Because he taught me to have a similar mindset is to be thrifty. And part of that's the, Scott heritage and all that. And, most
Right.
of the Scots I know are thrifty, um, but part of it's that, part of it's cultural and all that stuff. But I think in many ways, if you think about the nature of it, it's all, I mean, cultural or whatever. Like, people talk about Jewish people being cheap. My wife is Dutch. She's cheap, right? Like you think of
Right.
all these like ethnicities, they're all considered quote unquote cheap. But the reality is it's cultural, and some of it's the times, right? If you go
Right.
through hard times, you learn lessons, and the lessons are good for survival, but they're not always good for thriving. Right? Because when
Right.
you're in the Great Depression, you're not thinking about, oh, how I can become the next Elon Musk. You're thinking, how can I put food on
Right.
the table for my family and make sure my kids don't starve?
Right.
So it's
Right.
hard to like we're in a golden age for like the last 100 years or so, almost 100 years, where things have consistently gotten better. There have been bad times, I'm not gonna lie, and some people have it rough as well. Like I'm not saying everyone
Right.
has it easy, but if you look at it as the country as a whole, things have gotten better and as a whole, and we've made a lot of progress, and certainly it's been lopsided, but it's definitely been progress.
Yeah.
um
Oh, absolutely. I don't, did you ever read that or hear that book by Hans Rosling called Factfulness? It
Never heard
was a
of it.
book. He's now passed. It came out maybe 10 or so years ago, right after I think it was actually produced posthumously by his family. But he was like this. He's a medical guy and did all this stuff. But his whole thing was kind of what you just said, which was it's easy for us to get down, but if you look at 100-year trend, we have so much more and we have so much more to be thankful for. But it's our nature almost to forget the good stuff and focus on the bad stuff. But his point was statistically, on average, it's good stuff.
Yeah, I think it's hard. I didn't read the book, but it's what is Triumph of the Optimists. There's a whole bunch of books that go out there, and this is actually something I don't really particularly like about Wall Street. Is Wall Street tends to be very perpetually optimistic. Like there's certain people out there who are permabulls, and there's one guy who I can't stand. He's a gold bug. He's a permabull gold bug, but he's bearish on the whole economy. Like you've heard the name, so I'm not going to mention him, um, but he's bearish on everything. Oh, everything's going to fall apart. The world's going to blow up. The
Right.
U.S. dollar is going to zero. Blah blah blah. Buy
Right.
my gold. And it's like, don't be an idiot.
Right.
But I think Wall Street tends to be very perma-bullish,
Right.
and it's always like, oh, well, if you look at it. So when I started, it was this thing of there's been no 10-year period where there's been a negative performance in the index. It's never happened until 2000 to 2013. And they're like, there's been no 15-year period where this ever happened. I'm like, come on, like grow up.
Right.
But that's what happens, right? They're just like trying to find the optimism. And it's like, look, how about you just don't lose a huge amount of money when the market crashes? How about that?
Right.
Like, can we
Right.
focus on that? No, no, no,
Right.
no. We got to buy and hold because if you pull your money out, the whole system implodes. It's like a big Ponzi scheme. You have to trust the system. And not saying you shouldn't, but is built into the framework of what we do, right? It's
Right.
like saving for retirement. Like, yeah, save for retirement. As long as inflation isn't 20%, as if it
Right.
is, and you don't have anywhere to invest, you're in trouble, right?
Right.
Or what was that? What was that thing? I think it was Obama was trying to push the My IRA or something, and they were going to invest in government bonds. How
Wow.
much of a boondoggle would that have been? That would have been horrendous. Oh yeah,
That's
invest in our government bonds that we're overspending and it's going to be inflated away overnight. I mean, that would have been horrendous.
right. Right
So
now.
I
But
don't
to
know.
tell you, after the recent election, just like every locality, there's always the bond raises, right?
Yep.
For, building prisons, building schools, building whatever. And, I used to be on the side of, especially when my kids were younger and they were raising money for schools, I would just, yes, 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 whatever. And I've totally flipped on that, right? I'm like, no, 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 no,
Yeah.
no, no more money,
I
right?
think
Kind
it's
of thing.
I
Like,
think it's
let's figure out how to do more with the money you've got, kind of, is sort of where my brain
yeah, I
is
think
going
I mean I
to.
talked about that a few weeks ago where in some towns that have money, like the town I grew up was well to do. I didn't go to the public schools, I went to private school, but like the public schools, there are a lot of well-to-do people there. A friend of mine moved to Miami Beach, and I guess there's a school system there that's like one of the best around. And what happens is they get the same funding as everybody else, but some wealthy people are like, we need this school to be better. So what
Right.
they do is they donate money to the school to
Yeah.
help make the school better, which I think is great. I mean,
Right.
why am I as a retiree, and I'm not retired, but as a retiree, I don't have any kids in schools. Why am I paying for the kids' schools? That's ridiculous. But that's how
Right.
the system's built in. It's like, well, the amount of money you're paying into a nice, wealthy town is probably similar to what you'd be paying to send your kids to a private school. So I don't, I think the
Yeah.
whole school system is going to have to be re-engineered in the next few
Yeah.
years
It
anyway.
is it is interesting because when I think about we live in Fairfax County, Great Falls area, and outside of DC, just west of DC, not far from Dulles Airport, and when we were going through the whole criteria, where do we want to live? Pretty much it was the name of the area. It's the high school is called Langley, so it was the Langley Pyramid. We sort of went, and that was pretty much it. We wanted to live in really good public school district. And this is the one we found, and it is great. And but what you just said is exactly what happens. Everybody gets the same amount of money, but everybody's pocketbook is open if you're a person of means, and you basically find ways to enhance the education of that particular public school area. And that's exactly what happened here, I think. Now, what I will tell you also is but the majority of the funding still does come from our property taxes, and I always got a kick out of it in my area, which also relatively well-to-do, probably like yours. A lot of people still sent their kids to private schools, and I was always like, well, gee, this is nice. I'm paying property taxes to send my kids to school, and you're paying property taxes to send my kids to school. So I'd send them Christmas cards. Thank you.
Send me
You
a
know.
check next time, Jeff. I don't need a Christmas card. Just send me a check.
So, but I wanted to go back actually, Kirk, to one thing you were talking about before, and like the mindset of getting coming into the market in 2008 or 2009, right? Where there was, and I can't remember the exact date, but there was about a 40% drop in the market in 3 months. Arguably the worst time the market had gotten hit in history, or I guess maybe since the Great Depression. So I show that chart to my students, right? And that is the number one thing I'll show them. And I'll show it to them. I'll show the zoomed in view, which is that ugly 40% drop. I think it was like Q3, Q4 of that year. And it's all red, going straight down, scary, scary, scary stuff. And I said, that's hard. Could you imagine buying into this? Or could you imagine holding in this? And I'll start with that, but then I'll show them the other thing. But now let's zoom out. And I took them from that quarter to 15 years later. And what I'll say to them is like, and by the way, it was about a 500% run up. I'll say to them, but what if you had been scared out? You would have missed this entire run. So that's when we get into dollar cost averaging. And it's like, look, guys, the market's going to go up, the market's going to go down. You know, every business cycle, 7 to 10 years, it's going to go down some. Every 80 years or so, it's going to go down big. But it always comes back. Every single time it comes back. I'm not saying why it comes back is necessarily right. The Fed's pumping money, the president's fiscal policy is pumping money, whatever they're doing, it always comes back. So the key is not getting scared out. Set it and forget it and run with it. And don't be that person that got scared out. And of course, with the market going down 40%, a lot of people got scared out. And now they earned what, about 0 to 0.5% in savings accounts in banks for 10 years, whereas the people that stayed in got about a 500% return.
Yeah. Yeah, I think it's I think it's great advice for everybody is just kind of understanding the success frameworks. And I know there was a study by Fidelity which they've since denied that they did, but they did a study on their accounts of people who were dead. And they said that dead people outperformed the live people by some significant amount. And
Right,
it was just basically ignored accounts. They just invested and left, which, there's two sides to this. One side is, well, obviously the market's gone up so much, and
right,
so, you would have done well. The other side of it is, we got lucky it went up so much. What if we were Japan? What if,
right,
the market goes down for 30 years in a row before it starts to come back?
right,
That can happen too. I'm not suggesting it will, but we have an
right,
example of it happening in real time. It's just recently exceeded the peak in 1990. That's a long time, right? And
right.
so, could it happen here? Yes, it could. Is the likelihood? Probably not, because that's one of the Fed's fears. I was listening to a podcast a while ago. I thought it was a good framework. It was, think of our country as a bunch of assets, right? And then we have a bunch of debts on that. Um, our assets, like the debt, the U.S. government debt, is basically based on the assets and the cash flow of the country. So if our assets go down, we're bankrupt.
Hmm.
It's a Ponzi scheme, basically. It's like, well, as long as the asset prices go up, then we can support the debt. If the asset prices go down, like let's say asset prices across the board go down 50%, we're all bankrupt, right? So
Hmm.
they can't allow that to happen. So what do?
Right,
They, like you said, they pump money in the system, they boost up the market, it crashes, it comes right back because we got to keep it positive, and everyone's conditioned to buy, keep it going, and we'll keep going higher. So unless they royally screw it up and cause a deflation, and
right.
I don't even object to deflation, but if we do it in the wrong way, we're toast.
Right.
I think that's the result. But
Yep.
anyway, we're
That
getting
that's
close.
the bet you're making, right? Is
Yeah,
that they're the people that get paid to do what they do are finding ways for that not to happen. So,
exactly.
and the thing that I also talk to the students as well as through our my personal finance reimagine platform is, we talk about, you think of the twin risks of volatility and diversification, but I absolutely overlay time. And the way we think about it is, okay, it's like you want to, if those are really the three risks, you're going to want to expose yourself to one of those to make money, but then the other two, you need to be really disciplined about making sure that's your backup. So let me give you an example. Like if you're if you're going to expose yourself to volatility, right, which means say you're going to buy into an ETF or a mutual fund that's a super high growth, maybe foreign or other sort of riskier sort of propositions, or even like say a Gen AI or some sort of growing technology. Well, you're going to hit massive volatility. That just means you need to have diversification and time locked down, right? So to me, it's always about you need to seek exposure to risk, but you need to think about that there's just not one risk, there's actually three of them, in whichever one you're choosing to expose yourself to, the other ones need to be locked down. And so we spend a lot of time on sort of figuring out how to do that. But anyway, it just when you were just talking, it kind of made me think of that general approach, which is kind of a traditional perhaps approach in terms of like almost like a Markowitz thing with portfolio development. But maybe it's a little bit newer spin just because diversification, especially through ETFs, is become more and more, I guess, inexpensive and relatively liquid, so they're relatively easy to get into.
Yeah, I totally agree. We're going to wrap it up here. So final thoughts from you, Jeff, and then where can people find more about you?
Yeah, so honestly, thanks so much for having me on. Love our conversations as always. So ultimately, Personal Finance Reimagined is my organization. It's a decision-making and financial education platform. I'm a behavioral economist, so I really focus on how people make decisions as the primary thing, and then we plug into it different financial decisions that you make is kind of the use cases for that. So that's what we're all about. We have choice architecture, technology, all that good stuff to support. So yeah, I mean, anybody interested in learning more about that, you can reach me at my website, financerevamp.com. Drop me a line. We're doing lots of good stuff.
Awesome. Well, thanks again for coming on the show, Jeff. We'll definitely check out that site. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.